Going
All right,
live.
we're live.
We
Sam,
think we're
thanks.
live.
Yeah, it's good to get live with you on the call today. I wanted to talk about real estate investing is really something that I've been involved in for 34 years, and getting to know you the last 5 or 6 years on the multifamily side, it's been a very interesting uh, run to watch what you've been developing. And I want to just chat about the multifamily side of investing, right? To start with, if that's
hmm
okay. But how long have you been studying the real estate market yourself?
So I started investing actually before I was a licensed realtor in 2010, and bought my first flip. And so it's been a wild ride. That was the bottom of the market, and couldn't have timed it better. And I got to see and watch a lot, and it was a really interesting time to jump into the market and watch what's happened.
Yeah, it is interesting in that. I think one of the things I want to talk about today are the four true benefits, cash benefits of investing in multifamily real estate, as well as the three tax benefits. And I thought we
hmm
talked about that for a second. Um, and then for those that are interested, we can get more deal specific. But the four interesting things when you think about buying something, right? Whether it's a stock, a bond, or some other profit making opportunity, you generally have one stream of income, maybe two. And what's
hmm
interesting about real estate is you have four, right?
Right.
And so, for those that don't know the basics of this, I'm just going to mention those four. Number one is cash flow. That's what everybody expects. Cash flow on a property, um, cash flow meaning this is the rent you're getting for the property over and above the expenses of the property. That's the
Right.
cash flow. And I'll ask you a question about that, Sam. When you look at cash flow across the United States, what is the range of cash flow that you generally see with a new acquisition?
Well, at specific to our group, we want to see high cash flow, but it's scary. Right now, people are buying solely on appreciation, and there's a few people okay with minimal cash flow or no cash flow. And the reason that's scary is I mentioned I jump into the real estate market at the bottom of the recession. The people who survived that recession realized that cash flow was king, and that's what got them through. And so when we buy these assets, we're always shooting for a minimum of about 6%, 5 to 6% the first year as we're vacating units and remodeling units. We buy assets with a lot of upside. And ultimately, the goal is to hit double-digit cash flow per year.
So I'm going to share from right here on the coast of California, Southern California. We're seeing rates of as low as 2% return in
Mm-hmm.
California. Obviously, you may have the benefit of appreciation, but the returns here can be low. And then you
Mm-hmm.
go into other cities and you're seeing, like you said, 6, 8, 10, 12% in some cases.
Right.
So that's the range I'm seeing across the spectrum that is available with some of these properties. And then the second form of cash flow I'm seeing is, or benefit cash wise, right, is depreciation. And of course, on the big buildings, cost segregation. And we'll go into what cost segregation is maybe in a little bit, but depreciation is an immediate tax write off. And so that is actual cash benefit to owning the property. And then the third is appreciation. We all know what appreciation is. It's what you pay for it and then what the difference is in value over a period of time. So that's your third benefit. And of course, your fourth benefit being principal pay down. That means
Right.
you have a loan on the property. Your tenants are making the payments on the property. They're making their rent payments. You're taking that rent. You're paying down your principal with their money. So
Right.
you got four streams of income coming in on one purchase. And that's one of the beauties. Let's talk about for a minute the tax benefits. Sam, can you describe, because depreciation is number one, right? And so we in this world we call it cost segregation. Can you describe what cost segregation is?
Yeah, Ed, it's a huge benefit for commercial real estate investors. You can do it maybe on smaller residential properties, but it really comes into play on these larger properties. So instead of the IRS saying, hey, you can depreciate an asset over 27 and a half years or 35 years, we pay an engineering firm, someone who can go in and study the property and say, hey, you know what? That countertop's not going to last 27 years. That appliance isn't going to last more than another 2 or 3 years. And so they reallocate all of these items and they give them a schedule and they depreciate them much, much faster. And what that does is it allows us to, instead of maybe selling the property in 5, 7, 8, 10 years and then not being able to take advantage of another 17 to 20 years of depreciation, we get to use all of that depreciation up front in the first few years that we own the property, because we know we're most likely never going to own a property for that long. The law of diminishing return says you should not own a property for that long. You should take advantage of the equity you've gained and go upgrade and buy new property. So the IRS allows us to really, all it is accelerating the depreciation. Instead of 27 and a half years up front, we get to depreciate it in the first few years we own the property. And what that equates to is, in some cases, 7 to 8 to 10 times the amount of depreciation that we're able to use against our income or as passive tax losses. And it makes a huge difference, makes an absolutely huge difference, and a big enough difference that is the reason some people invest with us. They love the cash flow that we produce, but they really love the passive tax losses.
Yeah, and they can be tremendous. I think is one thing that's important to note is the only time cost segregation actually makes sense is on these larger assets because of the cost of the accounting process,
right?
To run and determine whether cost segregation is a benefit or not.
Right.
So you won't see it used on 4-unit buildings or single family residences as much, correct?
Correct. Yeah, it's cost prohibitive. If it costs $8,000 to $10,000 and you're going to spend that to do that on one home or 3 or 4 units, usually that just doesn't give you enough savings, and there's not enough. We talk about scale a lot. We're buying 310 doors right now, so we're going to spread that cost out over 310 doors and receive some pretty huge tax savings.
So the third tax benefit I want to mention is a 1031 exchange. Right now it's law and it's legal. Tax laws can change, so we'll see what's forthcoming. But the 1031 exchange is probably one of the greatest tax benefits in owning a piece of real estate, because if you ever want to sell that asset, you could take a lot of profit and defer it into another property. So whether you want to buy another property because it has higher cash flow or it's bigger, whatever the reason might be, you've got this tremendous tax benefit called the 1031 tax deferred exchange. You can roll all the profit into. We actually used to be able to do that in a single family world many, many years ago, but that's been, of course, removed.
Right.
So, let's get deal specific, Sam. I'm going to just bring up El Paso here on the screen if I can.
Sure.
But what I wanted to ask you is, there's a very great project that we have under contract in El Paso, and I want to talk about that. But tell me about El Paso. Why, there's 1,000 cities to buy in this country, and how did El Paso come up as an option?
Well, it's the fourth safest city in the U.S., and I actually got pitched El Paso by a property manager. And this property manager, who manages over 6,000 doors, said, you know what, the renter quality is fantastic. The demographics are great. It's a clean, safe city. It's stable. If you look over the last 20, 30 years, it's pretty darn stable. And that's the type of market we look for. We like landlord-friendly states, which Texas is. We like jobs and stability and predictability. So when we go to buy these assets, we want to be able to future pace our returns and have some sort of ability to say, and the trends are telling us that in 5 to 10 years, this is what the property will be worth. Here's where rents will be. And by the way, this market performed fairly well during the downturn. And so we look at all those data points for every market that we go into. But really what I love about El Paso, and we already own 160 doors there. And so we know firsthand experience that the renter demographic pays on time. It's a hot market. People are moving there. It's a great place to retire because it is so safe, because the temperatures are pretty moderate. One of the biggest military bases in the country is there. Virgin Galactic, Richard Branson just built his spaceport about an hour north. So you have people flying into El Paso to go to outer space or work at that spaceport. Lots of jobs, and it's a great place to live, and that has attracted a lot of people to move there, and it's still fairly affordable. So it's kind of the perfect combination of really clean, safe city, low cost of living, plenty of jobs, and stability. And as investors, we love stability.
Now, how about the building itself? What attracted you to the building?
Well, it's beautiful. I mean, as you can see on the screen there, mature trees. And so El Paso's in the desert. Our other property has a few mature trees. But, if you drive through El Paso, you were there with me a few weeks ago. It's dry mountains. You have cactus. You're in a desert. And this is like a little oasis, a beautiful 310 unit apartment complex close to downtown, a little oasis in El Paso. And so people love living there. They love the mature trees, the landscaping, the 2 pools. And whenever I see a community like that, that's what I want to own. And if we can make the numbers work on a really good asset in a really good location, that's always a huge bonus. And so when we saw that the numbers worked on this property, I was ecstatic. I had already toured the property, had already seen it with our friend Michael Young, and we wanted it. We want to own apartments where people want to live, not just because it's a good deal, not just because we're the cheapest in town. We want to own communities where people have pride and joy where they live.
So here's some investment highlights. Why don't you just touch on a few of these here?
Yeah, we're buying it for $27.3 million. That's about $88,000 a door. We're planning on holding it 4 to 5 years. Every time we buy a property, we plan on refinancing out all of our cash or selling in 4 to 5 years. Again, because of scale and the law of diminishing returns, we want to take advantage of that forced appreciation, which is something we can talk about. We're always remodeling and forcing the appreciation and the values to go up. So we want to take advantage of that money that we've earned and buy a larger, better property or two more properties, and do that 1031 exchange that you just talked about, and continue growing our portfolio with similar properties. So we're raising just over 10 million. We've about half of that spoken for so far. This is a 506c investment, which means only accredited investors are allowed, and we're regulated by the SEC, which is why we do that. We're putting just over $1 million into it. And when we look for a property, and when I said the numbers work, what I look for is, can I make the property more beautiful? Can I improve it for the tenants? Can I make it a nicer place to live? Can I update it? And is there a delta in where rents are for an updated unit and what they're currently charging? And there's a big difference in what they're currently charging and what we can charge once we remodel the units. And so we love value add properties, and that's another tax benefit. The government wants us to improve these properties. They don't want to have to do it themselves. So what they said is, hey, Mr. Investor, or Mr. and Mrs. Investor, you go spend money remodeling a property. We'll give you another tax incentive to be able to write off once you remodel and upgrade those properties. And so there's so many benefits to this property, and we're really excited to have such a good one under contract and be able to buy it this month here in El Paso.
So I don't want to keep this thing too long, Sam, but I just say that if anyone's interested in learning more about investing in real estate and just wants some free education, just reach out to us. What's the best way to reach you, Sam?
So just my cell is 801-995-2220, or the website, mficlub.com. That's multifamilyinvestmentclub.com. So that's pretty easy, but just a text or a call. We have over $100 million in assets under our belt. So this isn't something that we're new at. And what we've learned is we want to buy properties that, again, are nice communities where people want to live. We want to be close to jobs. So this property is 1.5 miles, or maybe 2.5 miles from the hospital and the university and downtown. And we have doctors and nurses and resident students living in this community. So there's a reason, and we can get more into that as people call or want to talk to me, and we can get into why, but there's a reason we want to be close to hospitals. There's a reason we want to be downtown. There's a reason we want properties with mature trees. And all of that comes down to our bottom line. What can we return to our investors as a monthly cash flow? What can we project, and what can we actually produce as operators of this property? And so there's so many different things that come into play, and there's so many things that we've learned after building this $100 million portfolio that we're proud of, and we're proud to say we've been very conservative and done very, very well. And it's by paying attention to the details.
Yeah, and I think it's taken a conservative approach on all these things. I think we've all been through enough ups and downs in time and learn what mistakes to avoid. And I think the team is really focused on that. Again, if you want to see this offer memorandum, just reach out to either one of us and we can get that to you. We can have a phone call and discuss this opportunity as well as others that are happening around there. There's information on the screen, or reach me directly. And with that, any closing comments about investing or this project?
This will be the last one we do this year. We try not to grow too quickly. And I have a podcast called Recession Proof Real Estate Investing. It doesn't matter how much money you make if you don't keep it. And Warren Buffett's number one rule is never lose money. His number two rule is don't forget rule number one. So that's our approach. And we only buy a certain amount of properties specifically to make sure that we follow those two rules, and that we make a fantastic return, but we also have the lowest risk possible that we can achieve. And so I would say, let's talk about it. Reach out to Ed or I. It's a fantastic opportunity. And actually, I think we're going to hit a little bit better numbers than we had put on the screen. So that's always our goal, is to underpromise and over deliver.
Great. Well, Sam, thanks for jumping on this really quick for us this evening. And we look forward to hearing more about your questions or needs for information, and reach out anytime. Thank you.
Yeah. Thanks, Ed.
You got it. It was great seeing you.
You too.
All right.